We're news for business people. Good morning. Welcome to Bloomberg Quint Live, India's first digital live streaming business news service. I'm Menaka Doshi.
Good morning, Menka. Good morning, everybody. I'm Meera Dugal. This is Indian Open, and these are the headlines. The government's 2.11 lakh crore recapitalization plan could reduce lending rates and spur flow of credit into the economy. That's the majority view a day after the mega plan was announced. The cabinet also gives the go-ahead for a highway project worth 7 lakh crore, including the Bharatmala segment, 80,000 kilometers of roads to be built over the next 5 years. Infosys cuts its dollar revenue guidance for the year, says there's no merit in allegations of wrongdoing at the company. Co-founder Narayan Murthy says he's still disappointed. And India's largest reinsurer, General Insurance Corporation, will list on the bourses today. The issue was subscribed 1.38 times.
All right, Neeraj is missing this morning from our studio, but he's not missing from the show. He's standing by in Delhi, waiting for HCL Tech to announce its numbers. But before he takes us through the numbers at HCL Tech, he's also going to take us through the market setup this morning. And Neeraj, I know what you're going to say right up front: PSU banks, PSU banks, PSU banks.
Yeah, it's all about that, isn't it? I think we've been talking about this, Menka and I remember, good morning to both of you and all our viewers as well, that it's pertinent for the Bank Nifty to perform well, for the index to do well. The last 2 days, we've seen some signs of the Bank Nifty returning back to its mojo. Maybe, I mean, you don't quite say markets preempted this, at least the day before yesterday, but yesterday maybe the markets preempted a good move coming in, and therefore the Bank Nifty, the pivot really, and will lead to a positive gap up for the Nifty as well. The key is though, whether the index, the Nifty Bank, will sustain its uptick in all probability, or at least will start off well and will stay at elevated levels in all likelihood. The ADRs are testimony to that. But whether the Nifty can actually continue to do that as well remains to be seen. So the gap up, sustaining that gap up in the index is key as well for the Nifty. We will start off at record highs. The question mark is whether we continue to do that. It will also be important to see how Nifty IT performs in trade today. It will, of course, be dwarfed in a big way by what happens to the Nifty Bank. But if indeed HCL Tech were to come out with a disappointing set of numbers, you know that they will probably maintain their guidance. I think they spoke about that in the JP Morgan summit. So you know they'll maintain the guidance, but if the numbers are disappointed and Infosys will be off today, then the Nifty IT could be in a spot of bother. But not that it'll have a big impact on the index per se, but Nifty IT started to soften a bit. Infosys will drag it down further. You need HCL Tech to come out and deliver and give good guidance as well. So that is pertinent from a trade setup perspective. But a bunch of stocks, I mean, yesterday we were devoid of stocks that will react too well on market open today. I mean, is just so much happening. The ADRs have shown that State Bank of India, ICICI, and a bunch of others will start off on a really good note. So we'll have a big bang start for the Bank Nifty. That is a given. And we'll have a bad start for the for Infosys. That's a given as well. Not too bad, but maybe a couple of percentage points down after the 2% fall that we've seen yesterday already. So IT and Infosys in particular will start off lower. But a bunch of things aside of what will happen to banks. I mean, I think that whole road project, even though it's a 5-year target, I think the markets will probably get a bit excited today. So watch out for those. But Ambuja, yet another large cap cement name coming out with numbers which I thought were, and in terms of the dissection, slightly better than estimates, volume growth slightly better than estimates, so that could be interesting. Raymond had a very interesting quarter, and you now seen some of these counters, the pseudo textile stroke real estate counters starting to do well fundamentally on the quarterly basis as well. That could be interesting. And then a clutch of small caps and mid caps as well. I mean, International Paper, Saregama, splendid results, could be interesting movers today. Dr. Lal PathLabs were in Franklin Templeton Mutual Fund has bought some stake, so that could be excited today. But I know the market size will be focused squarely on what the Nifty Bank does, predominantly what the PSU banking stocks do. So that is an interesting one to watch out for.
Hey, Neeraj, what's the count today?
I refrain from mentioning any numbers on air, Menka.
Happy birthday, Neeraj.
I know, happy birthday. My gosh.
Thank you so much. Thank you so much.
That's the most muted happy birthday
I'm in
morning.
Delhi all year alone.
Well, you have HCL Tech for company.
Yeah, but yeah, I'll be back soon.
All right.
That's true.
Yeah.
That's true.
Okay.
Thank you so much, guys. Thanks for wishing.
This lag will kill any other further jokes we may want to crack on your age. So we will refrain from doing that as well. But I'm sure that the rest of the team will have a chance to do that or pull your leg through the course of the day. Thanks very much, Neeraj. Have a good morning. And I know you'll come back with HCL Tech numbers. All right. There, Neeraj, turning older, wiser, hopefully as well. On First Word today, sans Neeraj, the government's just given a booster shot to public sector banks. So will this be the turning point for the lenders? And all eyes will be on HCL Tech Technologies. Those numbers are out later today. We'll also get you a comparison between how Infosys fared versus TCS and Wipro. So a lot of tech talk this morning as well. And we've got expert views coming in on both. But first up, I'm going to throw it across to Ira, who's been calling this the best of the worst options in terms of recapitalization of public sector banks. I have never seen her smile this morning. Maybe I should wish you happy birthday.
It's been 4 years in waiting, I think.
Yeah, well, in that case, Ira, happy birthday. I think many people were waiting to see if the government did finally find the appetite to fund public sector banks, and they seem to have found it with a fairly large number.
Absolutely. So I think the announcement came and it did not come in half measures. I think that is, the big way to look at it. Just some numbers out there, the significance of this. This is a 2.1 lakh crore recapitalization plan over 2 years, largest in recent times. Just to give you a sense of the numbers, some numbers that I had access to from the McKinsey, from a McKinsey report suggested that you'd done about 90,000 crore, a little bit more than that between 2010 and 2016. In terms of recapitalizing banks. Then at 2016, fiscal 2016, you came up with the 75,000 crore recapitalization plan. So if you actually just put the numbers together very roughly, between 2010 and 2017, you've put in about 1.5 lakh crore. So what you're seeing now is 2.11 lakh crore being added in a 2-year period. By far adequate to meet Basel III requirements. That is what CRISIL also said. We had a chance to speak with the IBA CEO. His view was that this would take care of 80% of the capital that is required by banks. I presume he was talking about both Basel III requirements, provisioning needs, and also any growth capital that these banks use. Most of the views coming in this morning are relatively positive. So the rating agencies are positive on banks. We haven't got a sovereign view yet, but I'll get to that in a minute. We've had economists like Indranil Sen Gupta, Bank of America, Merrill Lynch saying that this will bring down lending rates per aggregate demand. We've had people like UBS coming in saying that this will boost the sentiment in the equity markets as well. Just a quick mention of some comments that Arvind Subramanian put out on his Twitter timeline late yesterday to explain the fiscal implications. Just putting those out there, he explained that the true cost of these recapitalization bonds, because, as you know, a lot of this recapitalization is coming in via bonds, 1.35 lakh crore. He says the true cost is in the interest payment. The annual interest payment, according to him, is about 8,000 to 9,000 crore per year. The cost, he says, will be offset by the by the fact that one of the most critical bottlenecks in the economy will be addressed. He went on to say that, yes, government debt will go up, but government fiscal deficit may not go up depending on how, rating agencies choose to view these bonds. And finally, I think the last point he made, which at least I agree with, is that accounting is moot because eventually these are government banks. They are the liability of the government no matter which way you look at it, whether you recapitalize them or you're responsible for any losses that they have, or in an extreme scenario, if they, if there are depositor losses, at the end of the day, it is the government's responsibility. They can't. I
have lots of questions. Okay, before we get to what the view on banks from a credit rating point of view, etc., is. Firstly, effectively, this over 1 lakh crore rupees that they're going to do in recap bonds. Just for those who are not necessarily familiar with recap bonds, tell me if I've understood this correctly. The government issues bonds. Banks buy those bonds. Based on the money raised through those bonds, the government pumps that money as equity into banks that they own, correct?
Yes.
Effectively, banks will buy those bonds using the plentiful deposits that they have?
Absolutely.
Correct?
Absolutely.
So now you're taking my money, which is deposit money, which anyways has in some sense been eroded because of the bad loans, which is the beginning of the problem and therefore the need for the recapitalization. And then you're converting it into equity through this financial engineering, and you're telling banks, here, take this equity and write off further loans.
No, that I disagree with. That I
so
completely
what?
disagree
No, how
with.
is that?
Well, look, this is money that was with the banks. What do banks do with deposits that they take? They lend a proportion, they put a proportion in government bonds, and they put other investments, to whatever extent they allowed, corporate bonds, etc. Credit growth has been low, so a larger proportion of that money has been, in any case, been going into government bonds. All banks are sitting on excess SLR. We know that for a fact, right?
Correct.
Now, what is the government doing essentially? So there is no liquidity problem. There is a capital problem, and that also a regulatory capital problem. And this is exactly how Y.B. Reddy described it when we had met him earlier this year. He said there is a regulatory capital requirement which is keeping banks at bay in terms of not being able to provision, etc., because they have to show that regulatory minimum capital, right? So these bonds effectively help them show that regulatory minimum capital, right?
But they're showing that regulatory minimum capital right
now. Barely, which is why they're not being able to take aggressive provisions.
But
because otherwise,
additional equity, aren't they going to use that to hopefully write off some of the bad debt?
All of that.
Finally take those aggressive haircuts,
pool, right? They need money to provision. So if they were to provision without the support of these recapitalization bonds, their capital ratios would fall below the regulatory minimums, which is why they can't do it. Now they have this comfort because these bond issuances plus the other cash that the government infuses gets counted towards regulatory capital. And I'm going to speak to Moody's about exactly how it gets counted, as in which bucket. But since they have that comfort, they can write down, or they can take steeper provisions on some of these loans. They can write them down, and then they can get back to the business of growth.
Okay, so one more question there. What is this business of growth? We've been flush with deposits, but lending hasn't picked up. There is everybody who's sort of correlating how this will strengthen. I get the lack of regulatory capital. This fixing that problem. It isn't fixing the growth problem, and in fact, if we've been sitting on plentiful deposits and still there has been no demand, so we have the supply, there has been no demand, and that may very well continue because that's more an industrial activity situation than banks having money to lend, right, which has not been the problem here. Now, I mean, I'm guessing that not all, a substantial part of those deposits will go towards buying these bonds, right? A little over 1 lakh crore.
Yes, but as
so
actually
that pulls some liquidity out of the system.
No, but as Jayesh Mehta, Bank of America Merrill Lynch explained, and it's I didn't think of this either, but it's obvious, right? When you have more equity capital, you can leverage it more, and hence you have more liquidity, which then comes back through various ways. You have more equity capital, right? And how do banks function? They leverage their capital. Who are going to
loan it to? Where's the demand? So where does
demand demand is correlation
not a factor. I get it. This correlation of, I get what problem this fixes.
If this capital was not there and tomorrow demand were to pick up, banks would not lend. It's a chicken and egg situation. Demand comes first, lending comes first. It's a chicken and egg situation. At this point, at least banks have enough capital that they're sitting on that should there be lending demand, they can go into it. For instance, we were talking about the Bharatmala project. A large part of that was private participation. There was also the need for NHAI to raise bonds, or whichever the agency is going to be to raise bonds. All of this capital has to come from somewhere. And you are not sitting on adequate capital in the banking sector, despite arguments saying that we have private banks. They're sitting on capital.
So what happened, Leera, to the argument? And we've discussed this before, right? Yeah. That effectively, maybe by not recapitalizing to the extent that everybody else was demanding, the government was allowing for weak banks to fade away. We discussed how they could become some versions of just payment banks. Remember that?
Yes.
And instead now we're going ahead, and I think in a couple of banks, I mean, obviously now governments, we also discussed the government reducing its ownership in public sector banks. This does the reverse. In some cases, I think it even exceeds the mandatory limits of, 85%, etc. So I'm just curious as to, I get the problem it solves, but is it really as great as it looks,
I think it's critical. Whether it's great or not, I don't know. Whether it's a good thing, should the government be doing more investment in banks? Should they privatize? Those are all sort of debates which we've been having for a long time. As things stood right now, this was essential. I know there were people who did not believe that this was a big hindrance to the economy, but I think world over, whether you look at the US, whether you look at Europe, whether you look at Japan, and I know the size of our banking problem was not comparable to those sizes, but I think this is the point that Viral Acharya had made in his last speech in September as well. The economic implications of a banking crisis come through in many ways and cannot be ignored. And we were in a banking crisis, no matter what anybody called it. I'm sorry, I've kept Shrikant Vadlamani, Vice President, Financial Institutions Group at Moody's Investor Services, waiting on the phone line. Very good morning to you, sir. Sorry to have kept you waiting. We got caught up in this debate on whether this is a good thing or a bad thing. But from your perspective, from a credit perspective, how are you viewing the announcement from yesterday?
We think it is a significant credit positive. It comprehensively addresses the capital issues of the public sector banks. That was the key credit weakness that they had. So from a credit perspective, it is a clear positive, a significant positive.
Mr. Vadlamani, you had estimates of how much capital would be required. I know that your estimates were for the Moody's rated banks. But if you compare the estimates you had and what has been put out in terms of recapitalization money, adequate in terms of sum?
Very much so. So we said that for the 11 public sector banks, they would require around $15 billion. Now, just if you look at that translates to around close to around 1 lakh crore rupees. Now, the recap bonds themselves are around 1.35 lakh crores. Obviously, we are talking about the 11 rated banks, whereas the government is talking about the entire public sector banking universe. And also, I suspect that the government may be building in much higher loan growth, whereas we were expecting the lukewarm loan growth that was there to continue. But keeping that aside, I think broadly speaking, the number that the government has announced, I think, is quite comprehensive. It is quite sufficient to both address the fact that the reported capital levels have to be higher and also to account for the fact that asset quality issues have to be addressed. There has to be adequate provisioning, and that itself will have a call on capital. So I think it factors all these issues. And on top of that, I think it buffers some for growth capital as well.
Mr. Vadlamani, can you help me understand how this gets treated at the bank end? This is Tier 1 capital?
Sure. I think there is some confusion. It's easy to break it up into two different tranches, this entire transaction. One tranche is the government giving money and buying shares, if that is what the government does. Now, if that is what the government does, that comes under core equity one, CET1. Yeah. The other tranche, which is causing a bit of confusion, is the banks buying these bonds. And in effect, that is how the government is getting the cash to buy the shares. But these are two different transactions, the way I would see it. So as far as the equity treatment or the capital treatment is concerned, the only point we would be focusing on is what are the instruments that the government will be buying in the banks. So if the government is buying common equity shares, that counts as part of CET1. There is no ambiguity about it.
Okay. No, a quick question. I just have a quick question both to you and to Shrikant, and this is that is it going to depend on what the nature of these instruments or bonds are? So do we need to be focused on some of those elements, term, tenure, things like that, or is this fairly standard? And from a bank credit point of view, it doesn't really matter. It may matter from a fisc point of view. Shrikant?
Sure. I think it matters, but it does not matter from a capital issue perspective. Now, there are three implications of this. One is the fact that the capital of the banks increases. The other two implications is that, one, the liquidity of the banks is a bit constrained because we are not sure if these would be tradable instruments. Number three, from a profitability perspective, we don't know what sort of yields that these instruments will have and what profitability implications will have. So directionally, it is very positive for capital, it is negative for liquidity, and it is negative for profitability. But given the current context, where the key overarching issue is one of capital and not really of either liquidity or profitability, I think that's a trade-off that banks would any day be happy to take.
Sir, we didn't get any detail from the government on how this capital is going to get divided between the banks. What would be your preferences and what would you like to see? Would you like to see the weaker guys get more capital? Because then that brings back the argument that we're throwing good money after bad. Or would you like them to, once again have stringent conditions attached to it, although I don't know how well those conditions actually work?
Sure. I mean, we don't have any preference. We are just commentators of whatever happens. But I think given the quantum of the money that has been announced, given the size, we would be very surprised if all the banks don't get a minimum amount of capital to A, satisfy the minimum Basel III requirements, and B, to adequately clean up their balance sheets. Now, what we suspect there will be differentiation is in terms of how the growth capital is apportioned, where maybe the government would pick some preferred banks which they judge are doing better and give them more growth capital so that they can grow their credit books faster. But as far as covering the bottom line and ensuring that the base level of capital is there, we would be very surprised if all the banks don't receive that.
All right, sir. Thank you so much. Really appreciate you giving us your perspective. That's the Moody's view. And I think all rating agencies have said this is a credit positive.
Yeah, look, everybody said it's a positive. We all know that, PSU bank stocks will rally. But if I can just be the skeptic in this entire thing and quote a line from a Macquarie report that I thought was well phrased, the line itself. And it says, if equity is raised by the government and injected, it's a great and ideal move. But issuing recap bonds and showing that as tier 1 is akin to financial engineering, as one cannot write off debt using debt.
No, absolutely. There is no debating that part. But
so I
like I said, the best of bad options.
I was just going to say that I fully buy into your best of bad options.
Yeah.
And I'm sure that, nobody else in the market right now is interested in any of our skeptical voices on this, mostly about how high will PSU Bank shares go today. But that's the story on PSU Bank. So we've got one more voice coming in later today. An important voice at that. We'll be speaking with former RBI Deputy Governor KC Chakrabarti. He'll join us at 9:30 today. So in fact, if you have any questions as investors in public sector banks or those involved in the financial sector, you can send us some of those. And if they're really good, better than Neeraj, we'll ask some of those to Mr. Chakrabarti as well. Let's move attention to the other sector that will be in the news or in the action this morning, and that is IT. 3 of the top 4 IT companies have already announced their second quarter earnings. And while none have really disappointed on the revenue front, it's the guidance outlook that has analysts worried. So who among TCS, Wipro, and then Infosys that released its numbers yesterday has emerged the strongest? What are the key takeaways? Agam Vakil is here to talk to us about all of that. Agam, I know you've got this prepared set of numbers. I'm going to throw you off your game a little bit and start by asking you that the worst thing about Infosys really was the change or the lowering of the revenue guidance, right?
It was the worst, but to a certain extent, even that was factored in because we always knew that they were going to lower the top end of the guidance. 100 basis points cut on the lower end of the guidance. Well, some were saying that it's going to come about and some weren't. But I think HCL Technology numbers are out.
Yeah, so maybe we should wait till we get some little bit more about the numbers. I think we might have... yes, well, nothing is yet. I don't have the numbers. So should we quickly talk about what the expectations are for HCL Tech? Because it's pointless going into a comparison at this point.
Right. Well, in terms of expectations, we're expecting about a 3.8% growth when it comes to the dollar revenues. We're expecting a little bit of contraction in margins at around 19.7%, and profits could actually decline by as much as 1.6% sequentially. And again, the big focus will be on the guidance. For now, it stands around 10.5 to 12.5%. I don't know if that will change after Infi has cut their guidance yesterday, but that's a wait and watch. But those are the basic expectations from HCL Technologies for now.
Yeah, I think we've got a net profit number, Agam, as you can see, and it's coming a little higher than expectations at 22.10, 22.7 versus 21.37.
Right. So I think, we're expecting a sequential decline. That's not come to be. This is going to be perhaps a small positive, but it's going to be all about what HCL Technologies has done in the quarter. And I'll be keen watching the revenue numbers, whether or not we see a big, change with respect to expectations as far as the revenues are concerned. Of course, dollar revenues are expected to stand somewhere around $1,950 million. So we'll have to wait and watch for that number as well.
Okay. Let me see if there's anything more that I can help you with to try and break these numbers down. But I think what we have is what's flashing on the screen, which is the net profit number right now. And beyond that, not much else. What else are you hoping for in terms of commentary from there?
Well,
sorry, Agam, I'm going to interrupt you there. I think we have Neeraj with the numbers there. Neeraj, you want to take it over?
Yeah, are the HCL numbers flashing on the screen, Menka?
Yes, you're
I'm
live
just
on air,
because,
Neeraj, and we've got the net profit number.
If they are, then there are some numbers that I have.
Yeah, you're live on air. We've got the net profit number, but we don't have much more, so you want to go ahead.
So it's a bit of a disappointment, Menka. Yeah, so there's a small bit of disappointment on the net profit for the quarter, Menka. You would have to admit that. It's coming slightly lower than what we were working with. In rupee terms, and I think the dollar revenue growth has also been a bit of a lag compared to what we were working with. So the expectations were that there would be some bit of growth, but I think the net revenue growth at 1928 is up about 2.3%. The expectations were that it will be 1956, which would be about 3.8%. So in reporting terms, for the quarter, dollar revenue growth slightly softer than what we were working with. I'm sure cross currencies helped them. The bottom line numbers in rupee terms are better. But keep in mind, they have maintained the EBITDA margin numbers in terms of expectations. We were anticipating 19.7 EBIT margins, and I think they've clocked in EBIT margins at 19.7%. The important thing, though, is that they have maintained their guidance. Their guidance has not gone down. I think the market would have worried after what Infosys did yesterday, whether the guidance could go off or no. That hasn't happened. In line with TCS in terms of commentary from whatever little I've read right now. But just 2 or 3 key numbers. One, dollar revenue, 1928, slightly lower than what we were working with. The PAT numbers you guys already have. EBIT margins at 19.7%. They've maintained that. And they've maintained the guidance for the year, both in dollar terms as well as in rupee terms. So that is probably a heartening sign. Maybe the stock could correct a little bit on account of what they've done in the quarter gone by. But the expectation is that they will come up and deliver well in the second half because they've maintained the guidance.
Neeraj, hang in there. We've got Agam here as well, and also joining us is Apurva Prasad. Apurva, what do you make of these numbers? Well, okay. I think we're having some trouble with that line. Agam, you want to go ahead with any more information that you have?
Yeah, sure. So I think the positive is that they've maintained their guidance. That's the big takeaway. And I was going through some other numbers as well. So as Neeraj was mentioning that the headline numbers are slightly below expectations, but that's not too much of a concern as long as HCL Technologies maintains its guidance. Even when it comes to margins, they're expecting and they've held on to their projected range of around 19.5 to 20.5. That sticks. In terms of dollar revenues, 1928, just $28 million short of what we were going with. And in terms of some of the key verticals, manufacturing has comes around 22.3% in terms of its contribution to revenue. So that is a positive. There's been strong client addition, and this is something that on the back of which HCL Technologies has maintained their guidance on. They've seen an addition of the smaller clients up as much as 24, and they've added 1 client in the $100 million category and 5 clients in the $50 million category. And this is the reason why they can expect to see growth in the third and the fourth quarter, which is again seasonally very volatile. So these are some of the factors that I'm picking up right now. And again, some currency rates that HCL Technologies is working with, they're basing their guidance on 65.5 to a dollar, and well, that's a currency, and this keeps changing. And on the back of that, they're also keeping their margins at around 19.5 to 20.5 for now.
Neeraj, you want to come in there?
Guys, so I'll tell you, just this one small bit that I wanted to point out is that infrastructure management services, which is the key vertical for HCL Technologies, has had a negative growth quarter on quarter. Minus 0.2%. Now remember, the belief was that infrastructure, they have not been able to close some deals, and thereby this quarter could be soft. The commentary from the management about whether quarter 3 and quarter 4 see some closure of deals in infra or no, that now becomes the key for the stock, because the backbone for HCL Tech, even though they're trying to go digital, and actually they've gone digital in a big way, but infra continues to be the lion's share of their business. And if this weakness percolates into quarter 3 and quarter 4, that could be a small bit of a problem. So I think also very, very important for the stock individually, aside of what reaction happens because of the reported numbers, is their commentary on infra management and whether they'll see closure of deals in quarter 3 and quarter 4, and thereby the growth coming back. I would presume, Menka, Ida and Agam, that would be the case, because had it not been the case, the company would have found it difficult to maintain the guidance that they have. So I'm just hoping, and we'll be speaking to the management in just moments from now, I'm just hoping that the commentary on infra management services is robust enough. And we'll also be talking to them about 2018, because the Morgan Stanley survey that just came out, the CIO survey that they did about 15 days back, spoke about some uptick in 2018, early 2018. Let's see if HCL Tech kind of echoes that sentiment also or no. But suffice, I would presume that there could be a mild muted reaction on the stock because of the delivery. The heartening bit is that they maintain the guidance.
I agree with Neeraj here, because when it comes to infrastructure, infrastructure management services, a big chunk of their revenues comes from this area, and if I'm not mistaken, a third of their revenues in this case. Now, the management has suggested in the previous few quarters that clients are taking longer to decide on the kind of contracts they want to give out. So there has been a lot of delay in decision making, and that's possibly one reason why we are looking at that decline, a sequential decline in the IMS segment. It remains a matter of concern. It is something that I have also read in a lot of reports, and this is one key area of concern from a lot of analysts as well. So yes, it'll remain something which we will all be looking out for when it comes to the management and their commentary.
Agam, we've got Amit Chandra, research analyst at HDFC Securities, joining us now for his thoughts on HCL Tech. Amit, what do you make of the fact that they've maintained margins, maintained guidance, but there are some concern areas in some of the headline numbers? Client additions are looking good, and as Agam pointed out and Neeraj have been pointing out, I think the managed services space is not looking as strong as it ought to.
Yeah, so in terms of numbers, the headline numbers are largely in line with our expectations. So in terms of growth, we're expecting 2.4% growth, and they delivered in line with that. So if you see, like HCL Tech has been the in terms of performance in terms of large caps, HCL Tech has been the top performer. So in terms of headline growth, it's actually growing at 12%, which is quite good enough as compared to the peers. So we say Infosys, it's like the top line growth is 6.5% YOY growth, and TCS is same line 7%. So HCL Tech has been going. So somewhere or the other, slight concerns are there, but overall we remain constructive in HCL Tech.
So now that you have the HCL Tech numbers, sorry, Agam, you wanted to go ahead? No, go ahead. All right,
so Amit, over the past three to four quarters, what we've also noticed is a lot of slackness in the infrastructure management services. How long can you expect this weakness to continue? Because even this quarter, we are looking at a decline in that segment, and it's a very crucial segment for HCL Technologies.
Yeah, so we have seen some kind of softness in the infrastructure services space for HCL Tech, but overall, we don't see that to continue for long. But as it has been indicated by the HCL management that the first half is going to be weak, and the acceleration can be seen in second half. So we expect some kind of recovery in the second half. But overall, the growth engine for HCL Tech looks better than what the peers are doing. In terms of they are the if you see the engineering R&D services, that has been the primary growth driver this quarter. So they have been they are the leaders in the R&D space, and the R&D space in itself is growing at higher than the industry average.
Amit, can I interrupt with a quick question here? Amongst the companies that have all announced their numbers so far, so we've got Wipro, HCL Tech today, Infosys and TCS all coming in, and not all of them have had a very good year to date so far. Infy for surely hasn't. What's your call on the HCL Tech stock? Which amongst this group of stocks do you like the most at this point in time?
Yeah, so if you see our recommendations, so we have been constructing HCL Tech based on the headline group numbers that they have been.
In that, after you seeing that number, I know you need to delve deeper into the numbers, but you're likely to maintain that after you see the numbers today.
Yeah, obviously we will maintain our rating. So among the
HCL Tech is top of the heap for you.
Yeah, it is.
Okay, so, and what's next right after that?
So after that, we have after HCL Tech we have TCS.
Okay.
So we have a neutral rating on Wipro and Techem and Infy as well.
All right. Okay, great. Amit, thanks very much for joining us this morning. Agam, anything else you want to add before we wrap it up and hand it over to
No, I just want to say that I will be watching out for how Mode 2 and Mode 3, that is their digital and emerging technologies, has contributed for this quarter, because that is something everyone's going to be looking out for.
All right, great. Thanks. We'll hear from the management. They're in conversation with Neeraj even as we speak. But for now, I think we're going to wrap it up on First Word.
Yes, and toss it over to Pradeep, who's going to take us through the markets. But before that, we will, get you a quick F&O view as well. So I think we've got through the two big stories, the banking story, the IT story. We haven't had a chance to speak in detail about the infrastructure and the road story.
Correct.
We will do that in the second half of the show.
Yeah.
Try and get a view on how that plan actually plays out.
Yeah, so I think these we've got a bunch of guests lined up, as Ira was talking about, to discuss the markets. We've got Sunil Subramaniam of Sundaram Mutual Fund. He'll be joining us later on today. Then about the government's 7 lakh crore rupee investment in roads and highways. We've got Vaidi Murthy of NCC joining us a little later on this morning. And we've got all the power conversation going on with PV Ramesh of REC. Not to forget that we already told you that KC Chakrabarti will be joining us a little later on in the morning as well. So we've got a lot of expert voices coming in this morning. Make sure you stay tuned. I'm going to hand it over to Navneet now for a quick check on what to expect from the F&O markets this morning.
Well, Medika, SGX Nifty is suggesting an uptick of almost over 100 points, which could be once again your all-time high rates coming up for the Indian markets. But let's see, these are the future rates. If you look at the cues from yesterday's trading session, the Nifty futures closed above the 10,200 mark. So that was a positive sign. In fact, the rollovers, which we were talking on day 3, were on the lower side. They picked up on day 2. If you look at the rollovers for Nifty, that was at about 32%. And for the Bank Nifty, the rollovers were at about 25%. Talking about the put call ratio, that went up for Nifty. That was at about 1.6 versus 1.3, and that was primarily, there was a lot of open interest additions seen for the 10,200 put. I'll take you through that, but the Nifty Bank PCR also went to levels of 1. In terms of active strikes in yesterday's trading session, there was unwinding seen for the 10,200 strike, which was seen some sort of addition in the last few sessions. So that shed almost 8 lakh shares, but look at 10,200, that added 11 lakh shares, and the 10,250 strike is also added almost 4 lakh shares. If I have to go by the premium and talk about the range for at least till the expiry date, it would be in the range of 10,165 to almost 10,280. But I guess SGX is already suggesting a move of above 10,300 today. Clearly, in terms of FI positioning, yesterday FIs added a lot of shorts on index futures. In terms of options data, by adding shorts on index, they hedge themselves by buying a lot of call longs and also writing more of puts. In terms of stock futures, you will definitely see a lot of earnings reaction for HCL Technologies. Infi will also be reacting, and a lot of your PSU banking space. Besides that, I'll also watch out for Havells, a counter which was down almost 7% yesterday. And from the PSU banking, Lord Pradeep, PNB saw a lot of action in yesterday's trade.
Thanks, Navneet, for all these details. And PNB will sure remain in focus in today's trade as well, because this is one of the largest PSU banks, which is under stress. So it's likely to get a lot of capital from the government, and other large PSU banks will also remain under focus. But what are the stocks that analysts are really recommending? Abhijit Pathak joins us, is director at Defined Edge Solution. Abhijit, good morning. So, we looked at yesterday's data, but today is a new day, it's a new beginning because of whatever announcements have come in. Will most likely open in blue sky territory. Thereafter, is it possible for you to look at some intraday targets and stop loss levels, really, assuming there is going to be a large gap up for sure?
Yeah, intraday after the gap up, I'll be looking at a level of 100 to 110 on the 10,200 call. And if that is crossed, this call can go to 140, 150, which means Nifty above 10,300 can go to 10,350, 10,360.
Okay, 10,350, 10,360 is the kind of level you're looking at, but I think Bank Nifty will remain in focus, which is most likely to, once again start outperforming the Nifty after the huge stimulus that the banking sector is going to get. What's your guess on that?
Bank Nifty, if it closes above 24,900, I mean 24,800 and 900 are a bit of a resistance level. But if it closes above that, it will be a big breakout, and it might go up by another 500 to 800 points after that. But then that 24,800 and 900 is the level which I'll be looking for.
Mm-hmm. So how do you really trade it? There is a gap up. We don't know where exactly the markets will open, and you have certain resistance levels, that you are working with. How will you really trade the market after it opens with a gap?
Yeah, typically what one does is the first 15 minutes high and lows are taken into account, and if that is crossed on whichever side, that's the way to trade, at least intraday. But again, there have to be tight stop losses, because today the range will be so big that I mean, taking a trade on an intraday level. That's why the cues from options come handy, and that is where I pointed out this level on 10,200 call. That will govern, because the IT space will be under pressure and banks will be bullish. So it's going to be a bit confusing to trade Nifty today.
Okay, before we take your stock calls, Abhijit, any PSU bank stock that you have been watching for a while now where you think there could be an opportunity? Because individual stocks is something that traders will be looking at other than Nifty Bank. Because in Nifty Bank, if you look at it, private banks account for roughly 70% of weightage. So if you want to play PSU banks, you have to play stocks more than Nifty Bank.
There are quite a lot of PSU banks which are looking good. In fact, yesterday in the FNS show, I had given a long in SBI, State Bank of India. So that a close above 265 opens 275 or 280 in State Bank, and you can go to 290 or 295 levels also.
Okay. Well, any other stock that you would like to recommend today?
Yeah, one stock which is looking good is Reliance Infra. If it, again, that also might gap up, but if it is available near 480 with a stop loss of 475, it can be bought for a target of 495 and higher.
Okay, thanks Abhijit for taking time out for us. Well, Avinash Gorakshakar will join us in a while, but before that, let's have a look at how commodity markets are doing. There is strong signal from oil, which is holding on at higher levels. There are talks that Saudi Arabia is focusing on reducing the inventories in developed countries. It's a hawkish view coming from a major player, major supplier of crude oil. Gold has slipped a bit on firm dollars, and actually all eyes are on what's happening with central banks. In US, John Taylor is reported to be the favorite to be the next chief, but the race now narrows down to Taylor and Jerome Powell. These are two players really in fray. That is what some of the top sources have been telling the media houses. On Thursday, ECB is going to indicate their plans for tapering, and next week, Bank of England may raise rate for the first time in a decade. So these are some of the pointers. If you look at the impact on base metal, it's not that negative though, although gold has slipped, but you look at most of the base metal, aluminium is higher, zinc is higher. Okay, copper is down a bit as we talk. Rubber is another commodity which has corrected marginally. So flat to negative on rubber and copper. Most other metals are actually trading strong. Well, look at the Asian markets. Nikkei is up 25 points, so not so much action in other indices. Hong Kong is up 180 points, so that's positive. Avinash Gorakshakar, Head of Research at Joindre Capital Services, joins us now. Avinash, good morning. Big day for PSU banking. How do you really see it? How strong is this stimulus, and how long will it last? How far could it take the markets?
No, I think Pradeep, the key question is the stimulus is definitely a large amount, and I think at least in the near term, the markets are happy that a lot of bad asset quality is going to be going to be wiped out because of this fresh infusion. Although this money is going to come over the period of next 2 years, I believe the markets would obviously look at the frontline larger PSU banks like a State Bank of India, a Bank of Baroda, a PNB, where a lot of incremental credit growth was getting hampered because of the earlier legacy problems of asset quality. So to that extent, it's a good move. Obviously, it means that a little amount of government debt will increase, some amount of obviously money will be raised by fresh equity, but overall I think the mood is definitely going to be positive for the markets, at least in the near term. With the bank Nifty accounting for almost 30% of Nifty earnings, I would presume that at least in the near term markets are looking forward for a accretion of adjusted book values, especially from the frontline banks.
So you like PSU banks? These are going to be the main beneficiaries of this plan of infusing 2.11 lakh crore rupees. Of late, market had kind of have been treating some of the corporate-focused private sector banks on a par with these PSUs. They were getting derated. Exactly. Stocks like Axis and ICICI Bank. Now, does it mean that PSU banks will probably be preferred over all the private sector banks, and this segment will not really benefit? They will continue to fall?
No, I think in the near term, Pradeep, there could be an overhang for the private sector banks simply because some amount of competitive positioning and some amount of aggressiveness from these PSU banks could be expected, because obviously a larger part of their market share were taken away by the private sector banks, by the NBFCs. So obviously to a larger extent, the markets would now factor in a better kind of visibility growth and a much more stronger balance sheet for these PSU banks. So yes, in the near term, maybe for the next quarter or two, you could see that possibly banks like Axis Bank or an ICICI Bank, these banks would obviously be looked down upon compared to a PSU bank.
just to ask a hypothetical question, suppose you were holding Axis Bank, will you sell Axis to buy SBI, PNB or BOI today?
Yeah, I think if you look at the numbers of Axis Bank, Pradeep, extremely disappointing numbers. The bad asset quality has actually come out of the watch list. So, that puts a question mark on the credibility of the management, which actually puts out a watch list. So, I would definitely look at something like an SBI, something like a Bank of Baroda, which has already been battered quite significantly. So, the risk reward definitely appears much better for these PSU banks compared to an Axis, which possibly could see further derating.
Okay, before we go to our research team, one last question. What happens to NBFCs? Like you said, NBFCs were also a beneficiary of the PSU banking books not really growing. So they had an open field. Now what happens? Will you also sell Bajaj Finance, for example, and buy a Bank of India or a PNB?
No, I think as far as NBFCs are concerned, I think it could be a sentimental effect, something like a Bajaj Finance or maybe a Capital First, Diwan Housing. I would believe that yes, there could be some pressure on margins, obviously because the competitive intensity would increase further. PSU banks would definitely have some more muscle power, but overall I would say that the housing finance companies, the NBFCs are much better positioned to fight the PSUs compared to pure private sector banks.
Okay, we will come back to you with more questions, Avinash, but let's now go across to our research team and see which are the other stocks they are focusing on. It's results season, there are results coming out and also detailed research reports from brokerages. Good morning, guys. To begin with, Nikki, Ambuja Cement is the number that you are watching out for, after ACC and Ultratech. How did Ambuja really fare?
So in line with the estimates number, but then it lacked the sparkle that we saw both in ACC as well as Ultratech. Inline did not go well with the street. If we were just supposed to look at the net profit figures, a growth of 10% coming there at around 272 crore, pretty much in line with our estimates. Net sales at net sales grew as much as 15.1% at 2,319 crore year-on-year basis. EBITDA at 15.1% with a figure of around 354 crore was also pretty much in consensus, and margins remain flat at 15.3. So what really went behind the making of these numbers? Also, there was an impressive volume growth of 12% that we saw at 5.02 MT in this quarter. Good volume growth was seen. Better pricing in West aided the top line growth of the company, but then the higher than expected volume growth was offset by the higher raw material prices, which to an extent weighed down on the EBITDA of the company. Premium products value-based pricing also aided the operating performance of the company. However, the lower other expense is what really went behind the operational efficiency. We saw a 6% decline coming in on those numbers. However, what was really surprising was the lower other income. Now, this led to a beat in the bottom line because we were expecting a contraction of bottom line of nearly 13%, but we saw a growth figure there. So we saw the contraction of other income as much as 12% year-on-year basis, but it was way less than what we were estimating with.
Okay, so just Ambuja Cement number. We'll also have to focus on Infosys and HCL Tech. Darshan, what else are you looking at?
See, there were a couple of other numbers that came out, Pradeep. Some of them were strong. You had Mahindra CI, in which sales were up almost 10%. Margins coming in back in the double digits, so 10% EBITDA margins that came in. Profit grew almost 45%, so strong set of numbers. Sanjeev Goenka Group company, Saregama, came out with strong set of numbers. Revenues up 76%. Margins at almost 9%. Profit was boosted because of an exceptional Saregama came out 76% top line growth, margins at almost 9%, profits up almost 100%. Raymond came out with a strong set of numbers. Sales were up almost 3%, profit up 140%. This was because of an exceptional gain that came in of 21 crores, but overall strong margins of 8.6% versus 6.6%. ICICI Prudential net premium income was up 21%, so that was a strong show. Profits were rather flat in trade. Weak numbers, ABB, weak set of numbers, miss across all segments, the top line, bottom line, as well as margins. Order book also was rather lackluster. So ABB will probably react negatively. The NLC OFS opens today, that will be in focus. In bulk deals, Tata AIA Life bought in stake in Dixon Technologies. Franklin bought in 1.3% in Dr. Lal PathLab, and Abu Dhabi Investment Authority sold in almost 0.6% stake that they had in TTK Prestige. So these are the stocks that you have to watch out today.
Okay, and we are in the middle of a busy result season really, Shraddha. Kotak is the preview you are looking at?
Absolutely, Pradeep. No surprises here as well, because Kotak, along with IndusInd Bank, HDFC, is yet another one where we usually see continuation of the steady trends. So asset quality and earnings trends are expected to continue for Kotak into this quarter as well. Net interest income is seen growing by about 16.5% and net profit at a faster 20.3%, as credit costs are likely to trend lower. Net interest margins could see some pressure on account of lower yields. Now, the Q1 net interest margin numbers stood at 4.5%. Loan growth is seen at a healthy 19% sort of a number, while the gross NPA number is expected to come in at 2.6%, the kind of number that we had seen in the June-ended quarter. So broadly, amongst the important things to keep an eye out for will be the management's view on the SME and retail demand. CASA retention, of course, would be important for Kotak Mahindra Bank. So any guidance on CASA, fee income growth and balance sheet growth will be important to watch. As much as will it be to watch its subsidiaries' performance, and any comments with respect to consolidation opportunities. That's generally what the market would watch out for.
Okay, and the next number would be HUL. Looking at what happened to Colgate, what kind of volume growth are we expecting from HUL?
Well, a relatively healthier one, because it's going to be a quarter on which they've had a very low base. So that is something that is going to play out. But let's start off with the headline numbers. We're expecting about a 7% growth. Margins expected to expand as well to around 19.7%. Consequently, we could see a growth in profitability as well. The reason why we're expecting growth on the top line is 3 to 5% growth in volumes and another 3 to 4% a hike in prices for certain categories. We're expecting a healthier growth in personal care and home care on the back of low base, as I mentioned earlier, and we're also expecting a lot of advantages to come as far as raw material costs are concerned. Do remember the company has also taken certain cost saving initiatives, because is another reason why we can expect your margins to expand. So on the whole, we're expecting a steady quarter, but this will be largely on a low base.
Okay, thanks a lot, guys, for all these details. So we'll be watching for some important earnings in today's trade. Avinash, since banks will remain in focus, what's your call on Kotak Mahindra Bank?
I think, Pradeep, the numbers are likely to be quite strong. In fact, we expect a 21 to 22% growth in the profit, and most importantly, asset quality should remain stable. Our sense is, I think, now with the PSU bank recapitalization, I think everything would depend on what kind of growth outlook, the management spells out. I would believe that, they have been growing more on the fee income side, on the securities side. I think on the core business banking side, one would like to hear what kind of loan book growth and what kind of, segments would they be, looking at aggressively. But overall, I think the numbers definitely should be much better than what the street expects.
Okay. Mukesh Singh, Head of Technical Analysis at Neela Financial Services, joins us now, and also Vishwesh Chauhan, Head of Quantitative Research at Monarch Net Worth Capital. Vishwesh, your take on HUL. How is the market really positioned? And today, if there is a gap up on Nifty, definitely HUL will be a beneficiary. We are also looking at numbers. What kind of range, what kind of trade do you really see here?
So I think in a very shorter term, all this, FMCG stocks were definitely in the range, whereas the HUL was a little better poised. But I think in a shorter term, if it manages to move above 1300 or 1290, that is a sort of a range, then probably you're talking about a move which is much higher, and then probably you could see 4 to 5% move. So I think with the kind of a tone we are likely to open with a 1245 sort of a stop loss, one can consider to buy and assume that it manages to move over 1280, then you can get a 4 to 5% move. So in that case, 1350 should be the target one can expect on HUL.
Mukesh, what is your top trade for the day?
Yeah, hi. The likely trades for the day are Ashok Leyland is a buy at 128. Stop is to be placed below 124. For the upside target seen around 136. And the second trade is Sun Pharma. It's on the sell side. It's a conditional trade. Selling is to be done only when the prices start sustaining below 531. And in that case, traders can keep a stop at 540 and expect a downside push towards 510 areas in coming days.
Okay. Well, Mukesh has an ambitious target on Nifty, and we'll come back to that. But Vishwesh, what are your trading calls this morning?
See, I think Pradeep, we are likely to definitely gap up, and the gap would definitely give a lot of surprises to call writer. In yesterday's session, there was some indication by the 10,200 writer, which were covering their position. So I think today we would expect that if there is any post open decline, then it will be most likely bought into. So on Nifty, probably around a 10,280 if we get, so then in my opinion that will be a good buying opportunity with a 40 odd point stop loss. You could expect a target of 10,350. Bank Nifty is where I will I'm feeling that there is going to be more action. So about when 24,500, you can straight away buy that with a 24,300 stop loss, and I think it can inch towards 25,000. So in that case 24,950 should be the target. On the stock specific, I think one PSU stock which yesterday giving a very good comfort and data was indicating a move is Syndicate Bank. I think in a very shorter term you could buy that with a 70 stop loss, and you could expect a target of 80, 85. And second stock is a Jet Airways. That stock seems to be bottom out in a shorter term, so I think with a stop of 500 you could consider buying. You could expect a target of 560 over there.
Okay, so Syndicate Bank is a mid-cap bank that we'll keep an eye on since Vishwesh has a target of 80, 85 here with a stop loss of 70, and PSU banks are really the flavor of the day. But moving on to our special segment, Bloomberg Edge, and my colleague Jayesh Khilnani is standing by with some details on Jet Airways. Jayesh, what's the signal?
Morning, Pradeep. So it's a buy signal coming in for Jet Airways. One of the guests previously also mentioned that they have a buy call. Now let's have a look at what technical indicators. This time I have two indicators that have actually signaled a buy on Jet Airways. First one is the trender indicator. So with yesterday's close price, the stock price has closed above the key resistance that was pointed out by the trender. Now trender is a proprietary Bloomberg indicator which uses average true range as a key input to the calculation. It generates buy and sell signals and also helps you to maintain the stop loss. Now how are the buy and sell signals generated? Very simple, just follow the colors. Green is indicative of buy and red is indicative of sell. Going back to the chart of or rather, let's have a look at even the candle sessions that we have. So that's the candle session number 1 that has got recorded on the pattern itself. The red line was the previous sell signal that was indicated by the trender. With yesterday's close price, it has closed above this red line, which means that the stop loss of the previous signal has been met and a buy signal has now come in. Now the candle sessions is very important because this is the first candle that has the number 1 has appeared over here. In the last 6-7 months, there have been 2 instances where such a pattern has been formed. Have a look at somewhere in May where the first candle was formed. Now this candle also was an up move of about 10 odd %, but the stock still managed to move up for more than 12 to 13 days after this 10% move. The same situation we saw earlier this year in Jan, which panned out, and we saw session number 13 being recorded. So if a similar pattern plays out, we could see Jet Airways rallying from here for the next 12 to 13 days.
Well, thanks, Jayesh, for all these details. So Jet Airways is something that our Bloomberg terminal is also indicating a buy on our own proprietary trender, and as well as Vishwesh Chauhan giving a buy call on this stock. So Jet Airways will also remain in focus. An interesting swing trade. Let's see what happens after yesterday's move. But Avinash, IT will also remain in focus. We talked about banking a lot. HCL Tech and Infosys. How do you look at both these numbers, and what's your call on these 2 stocks to begin with?
I think clearly, as far as Infosys is concerned, I think obviously as per expectations yesterday the guidance got cut, and I think this is going to be a drag on the stock at least in today's session. In the near term also, I think the market should obviously look at it very cautiously. Our sense is that I think the stock may not correct sharply, but at the same time the risk reward is also not very great. HCL Tech has also given a decent set of numbers, largely in line. The guidance has been maintained, but I think clearly, within the IT space, Pradeep, I would believe that the smaller IT companies, something like a Persistent, a Majesco would do better, because the frontline IT companies are going to face a key challenge in terms of the headwinds from the US market, and margin pressure would definitely continue. So I would believe that both these stocks, HCL Tech and Infosys, could at best be market performers. In relative terms, I think to expect outperformance from these stocks in the near term would be a bit difficult.
Mukesh, how do you think one could trade HCL and Infosys quickly?
Yeah, for Infosys, I think we have got a strong support seen around this 915 area, and that happens to be the trendline support of last couple of months. If that is lost, then I think this particular stock can head lower towards 880, 870 kind of area. And as far as HCL Tech is concerned, then till yesterday it was recording 52-week highs, and today all of a sudden things are looking a bit bleak. But I think this 875, 880 kind of area might offer a good support. And between the two, this one seems to be a better trended stock as far as uptrend is concerned. So I would be looking to buy somewhere around 875. And Infosys, as I said, a break below 915 can trigger a bit of a decline towards 880, 870 kind of area.
Okay, we have 20 seconds to go before pre-open. 10,360 up 136.37 point is what SGX Nifty is suggesting right now. We'll also keep an eye on rupee, because it would be interesting to see how foreign exchange market reacts. There could be a negative reaction in bond market, as some of the experts were telling us yesterday. Some of the early trades are here. Now we can see Nifty at 10,321, 10,388, closer to 10,400. 10,440 is the target that Mukesh has given, and we'll of course talk about it, how he's arrived at this target. But we are actually in pre-open inching closer to that one. 10,404, 430. Okay, 440 is almost there. 10,440, 41, 42 is what Nifty is now looking at. Let's look at some of these stocks. SBI, PNB, Bank of Baroda, Bank of India. These are the stocks to watch out for. SBI is up 10%. Let's see what has happened to Bank of Baroda, up 10% as well. PNB, Bank of India, Union Bank. These are some of the large banks, and you can look at all of them quoting 10% up. Well, that's interesting. Let's look at some of the mid caps like Syndicate Bank, Vijaya Bank. Indian Bank is on your screen right now. Syndicate is also up 10%. Vijaya Bank should also come on your screen. You know, there are some of the weaker banks like IDBI Bank. There is Indian Overseas Bank, even Dena Bank for that matter. Okay, even IDBI is up 10%. Dena was up 11-12%. What happened to IOB? Is up 20%. IOB, and also look at UCO Bank and United Bank. These are some of the weakest PSUs, so to say, and they are still closing very close to. United Bank, I think till last week was hitting new 52-week lows. That stock is also up 13%. So uniform up move, 10% odd levels on most of the PSU banks today. What happened to private sector banks like ICICI and Axis Bank? As we discussed, you know, they are off late. They have been getting clubbed with PSU banks because of the high NPAs they have. Well, ICICI can see some relief. Axis can also trade up. HDFC Bank is down 10%. Now that's interesting. Are customers going to shift away from HDFC Bank? Will everyone go to SBI and PNB now? Unlikely. So we'll wait for that one to settle. Yes, Bank is of course quoting positive. Let's look at Infosys, HCL Tech as well, and also Ambuja Cement before we move on. Well, this is Infosys down around 1%. HCL Tech is also soft. 4 rupees 55 paise. That's a marginal cut. Ambuja is trading flat. Let's look at rupees 65.15 versus 65.07. So that is the reaction. We'll try and get you the reaction from bond market as well. Yesterday, as Jayesh Mehta of Bank of America Merrill Lynch suggested in a conversation with Bloomberg Quint Live, that there could be a 4 to 5 basis point uptick on yield. So bonds may correct, and well, rupee has also corrected a bit. So forex and debt market will probably react negatively. That was the idea, that was the call coming from those experts, and well, that's bang on target as well. Let's look at Nifty once again before we move on. How is it doing now? Have markets settled a bit? 10,360 was the indication from SGX. Nifty right now at 10,209. Is HDFC Bank still down 10%? If that is the case, then maybe it will recover, and so will Nifty. So let's have a look at HDFC Bank. It's still down 7.5%. Well, this I hope will recover, and therefore Nifty will also give us a much higher tick on the open. Sensex is up 270 points, more or less in line with expectations. Let's move on and look at some of the interesting brokerage calls. Morgan Stanley has turned bullish on PSU banks post the capital infusion, while it has upgraded SBI and Bank of Baroda. It has also upgraded ratings for ICICI Bank and Axis Bank. Somit Sarkar is standing by with the details. Somit.
So now Morgan Stanley is saying that this capital infusion will break the 5-year plus non-provisioning cycle for the banks and will benefit the PSU banks directly and the private banks indirectly. Now PSU banks will see the proper provisioning, expansion of balance sheet and sooner than expected improvement in return on equity post this capital infusion. Now Morgan Stanley is expecting SBI, PNB and Bank of Baroda's adjusted book value to grow 12%, 10% and 10% respectively by financial year 2019. Now this move also potentially implies that RBI will implement Ind AS on banks from 1st April 2018, and this along with clearing of non-provisioning loans from system will benefit the private banks. Now Ind AS will allow private banks to recognize losses in the transition period, raise capital if they need, and will also potentially move to normalized provisioning from financial year 2019. Now for ICICI Bank, PNB and SBI Bank, Morgan Stanley has upgraded their rating to overweight from underweight. For ICICI Bank, they have hiked the target price to 345. For PNB, they have doubled the target price to 180. For SBI, the target price has been set at 360. Now for Axis Bank, they have upgraded the rating to overweight from equal weight and have hiked the target price to 555. For Bank of Baroda, they have upgraded the rating to equal weight from underweight and have hiked the target price to 170 from 110.
Well, thanks, Amit, for all these details. So the big question really is this really a PSU banking stimulus or is it an economic stimulus? You know, because banks like ICICI and Axis will also improve if the economy overall improves and the performance goes up. Also, various other cyclical sectors should really benefit. So this is a call on these banking stocks coming from a major brokerage. Now, and there are rating upgrades. Well, now if you look at the market, Nifty has recovered a bit from the lows that we saw earlier. 10,358 is what SGX hinted at, and 10,325. So that is what we see on Nifty. This is in line, up 1%. And Nifty Bank also, although private banks have much higher weightage in Nifty Bank, but look at what is happening to ICICI Bank, and that should support Nifty Bank as well. No quote so far. Well, we'll wait for that one to settle, and we'll probably get it in a bit. Avinash, if you have to choose one or two banks, what are you going to look at?
No, I think clearly, Pradeep, as I mentioned to you, the PSU banks will offer a better risk reward, frankly, because the kind of fund infusion which is going to come in is going to obviously strengthen the bank's balance sheet. So SBI definitely looks quite attractive. Even at the current level, I would believe that if somebody has a short or a medium term view, SBI definitely would be a big beneficiary of this fund infusion. And I think the asset quality, if you compare it with all the other PSU banks, it definitely is stable. They have been making efforts to, you know, recover most of the bad assets. So SBI definitely could be a better choice compared to the other PSU banks.
So SBI is your top pick. Any other bank? I mean, SBI has always been the better one.
I think within the smaller banks, I think Indian Bank could be a tad better. I think numbers are much better than the other PSU pack. So
I think they also have NPAs around 7%.
Yeah, so I mean they are slightly better if you compare it to an IOB which has got a GNPA of almost 20-odd%. So, you know, I think value should be looked upon wherever the balance sheets currently are pretty strong and would obviously get stronger once the fund infusion takes place.
Okay, so Indian Bank, which is better managed, better run, a stronger PSU bank, which is a mid-size PSU bank actually. Indian Bank is the one that Avinash likes, and also the bigger one, that is SBI. Well, let's move on to insurance now. Country's largest reinsurance company, GIC, will make its stock market debut today, and Saloni is here with us with all that we need to know about the company and its IPO. Saloni, the issue didn't see the kind of demand some of the other recent IPOs saw. What's the kind of valuation expected on listing?
Well, absolutely correctly mentioned by you, Pradeep. GIC, that ensures the insurance companies, will be listing its mega 11,370 crore IPO today. The issue price is set at ₹912. Now, in terms of business, it is the largest reinsurance company in India with a market share of over 60% and 44 years of experience in this industry. Now, in terms of subscription, the IPO has been oversubscribed close to 1.37 times, with QIB subscribing over 2.6 times, However, the HNI and retail category portion was undersubscribed due to higher valuations according to a Macquarie report. Now, in terms of valuation, if the stock lists exactly at the upper band of 912, it will command a valuation of over 80,000 crore. However, if the stock lists at a discount of 875 rupees, it will command a valuation of over 77,000 crores. Now, however, if the stock lists at a premium of 950 rupees, it will command a valuation of over 83,000 crore. Now, given the market cap scenario, the price to book will vary in the range of 3.8 to 4.1 times. Now, in terms of operating metrics, the loss rate, in terms of financials, the gross premium earned has seen a compounded annual growth rate of 32% over the past 3 years. Also remember that GIC's 30% of the gross premium comes from outside India, and it has witnessed a compounded annual growth rate of 25% over the same, while the net profit grew at 9% during the same period. Now, in terms of operating metrics, the loss ratio, that is the claims incurred as a percentage of net premium received, stood at 81%, while the net expense ratio stood at 18.5% and the solvency ratio stood at 2.4 times as compared to IRDA mandate of 1.5 times. And finally, when you compare GIC with global peers, it has the highest investment yield of 12.3%. It has the lowest net expense ratio. However, on the flip side, it has the highest combination ratio of over 100%. Now, combination ratio is nothing but a combination of net expense ratio and loss ratio. Now, the company plans to reduce it to 95 to 100% in the short to medium term, Pradeep.
Well, thanks, Saloni, for all these details, and we'll take an expert view on GIC as well. But let's talk about Reliance Nippon AMC's IPO that opens for subscription today. The country's third largest fund house is looking to raise over 1,500 crore rupees from the market. Somit Sarkar is here to tell us more about the issue. Somit.
So, Reliance Nippon will be looking to raise as much as 1,542 crore rupees at a price band of 247 to 252. Now, at upper price band, the company is commanding a valuation of more than 15,400 crores. Now, of the total issue size of 1,542, 925 crore is an offer for sale, where both the promoters will be diluting their stake, and rest 617 is a fresh issue which will be mostly used to invest in its alternative investment fund and mutual fund business. The company will also be keeping aside 165 crore for future acquisition. The other raised amount will be used for opening new branches, IT upgradation, advertisement, and for general corporate purpose. Now, Reliance Nippon is the third largest asset management company in India. The first two are ICICI Pru and HDFC AMC. Now, its AUM, that is asset under management, stands at 3,84,000 crore as of August 2017. Now, of the total AUM, 29% is invested in equity, but it is the equity funds which drive most of the revenue for the company. As you can see, 60% of the revenue comes from equity-oriented firms. Now, this is because they charge more fees from equity-oriented firms. So, equity-oriented firms, they charge around 1.29% fees.
Well, Somit, the big question is, how does it stack up against its peers, if any?
See, when you see its financials and its comparison to its peers, now Reliance Nippon's revenue and net profit grew at a compounded annual growth rate of 21% and 15% over FY13 to FY17, which is lower at the rate the rate at which ICICI Pru and SBI funds grew, but it is at par with HDFC AMC. But if you see the return ratios of Reliance Nippon, it is the lowest when compared to its peers. Now, ICICI return on equity for ICICI Pru is almost 3 times that of Reliance Nippon, and it is more than 3 times that of when it comes to return on capital employed. Now, coming to the valuations, at the upper end of the price band, the price to earnings stands at 38 times, while price to book at 8 times. Now, while the market capitalization to asset under management, which is one of the important metrics for an asset management company, comes at 4 times. Now, this valuation of 4 times is cheaper when compared to the valuation at which its promoter Nippon Life acquired shares. Now, Nippon Life acquired stake in 3 different stages at a valuation of 6.6 times and 5.6 times. And if you see brokerages, now all brokerages have a subscribe rating on this IPO on the back of its steady financial performance, diversified product offerings, and strong distribution reach, and on account of the long-term growth prospect that the company brings in with itself.
Well, thanks a lot, Somit, for all these details. We are just minutes away from the market opening, and we tell you all that you need to know to stay ahead of the trade today. PSU banks will be in focus after the Cabinet's 2.11 lakh crore rupees recapitalization plan. SBI's GDR traded 15% higher, while ICICI Bank's ADR was up 8% in overnight trade. So these stocks have also opened up this morning in pre-open session. Infosys second quarter results met analyst expectations, but the company cut its guidance in constant currency terms. The company's ADR ended 2% lower. Ambuja Cement's earnings met with estimates. Mahindra CIE, Raymond, Saregama, International Paper and ICICI Prudential reported a strong set of numbers, while ABB India disappointed. So let's see how that one is doing in pre-open. Well, it's also positive, not bad. Shifting focus to primary markets, General Insurance Corporation will list on the bourses today. Issue price for the same was at 912 rupees per share. The issue was subscribed 1.38 times only. Reliance Nippon Asset Management IPO opens for subscription today. Infrastructure stocks will also be in focus after the government outlines a $100 billion road building plan for the next 5 years. And among earnings today, we'll have to keep an eye on Hindustan Unilever. Kotak Mahindra Bank will also watch out for Imami, Ingenious India and Exide Industries. These are the companies that will report their numbers in today's trade. Well, let's see how the market has stabilized now. If you look at the top gainers, all banks and nothing else, only PSU banking is what market is focusing on, and markets will open in a while, and let's see then what happens to the likes of SBI, PNB or the smaller ones like Central Bank, IDBI and Indian Bank. Well, Nifty at 10,324 has opened more or less in line with what SGX had really indicated. Sensex is above 33,000 mark and Nifty Bank has crossed 25,000 once again. So that's interesting, up 3.5%. So PSU banks really have just 30% odd weightage in Nifty Bank, which means PSU, not only PSU, but private banks are also doing well. Let's look at ICICI Bank to begin with and also Axis Bank. These are the two major banking stocks in private sector, which we have been watching out for. SBI is up 15%. That's a heavyweight. ICICI is the other heavyweight in Nifty Bank, which is a private sector bank. Can we pull up quickly? Yes, 12% on ICICI Bank, close to 300 mark for ICICI as well. And what happens to Axis Bank? Let's also look at that one. So market has really opened firm, and if you look at it, there is full support from banking sector at least, and also maybe some of the other sectors. So let's look at how the heat map is really faring. SBI, ICICI Bank, but you also have L&T here. You have a Z, you have a Ultratech Cement. So all these sectors are kind of helping. IOC, Vedanta and heavyweight RIL is also up 1%. If you look at the entire heat map today, well, we can say roughly 80% stocks or 75% stocks at least are doing well, which means the gains are not limited to banking sector. Where are the losers? HCL Tech is down 1.5%. You have Bajaj Finance down 2%. So that's the big question we have been asking for. Can NBFCs really sustain these valuations if PSU banks get back their mojo and start competing fiercely? So there is correction in Bajaj Finance. There is correction in Indiabulls Housing. There is correction in Yes Bank, private sector bank. Kotak Mahindra Bank ahead of numbers, down 1.5%. IndusInd down 1.5%. HDFC down a bit as well, which means it's difficult for Nifty Bank also to sustain because these private banks have a very, very high weightage compared to the PSU banks. So that is the picture so far. We have positive start for the markets. The gains are actually led by PSU banks, but private banks are not doing that well. NBFCs are also correcting. Sensex is up roughly 400 points. Nifty is also getting stuck at higher levels because, mind you, these private sector banks also have a high weightage if you look at the Nifty, because the financials command roughly 1/3 of a percent of the weightage in Nifty, and that is kind of probably weighing on Nifty at higher levels, which is down, which is below 10,300 now, is still up 85 points. Sensex is up only 350 points now, when the culprit HDFC and HDFC Bank that you can actually see here on this wall. Sunil Subramaniam also joins us this morning to discuss markets. Sunil, what's your take? How far could the PSU banking stocks rise? After a gap up, is it still an opportunity to buy these PSU banking stocks?
Absolutely, because I think what you're seeing today, the bounce is basically an announcement-related bounce. But if you look at the real impact of the recapitalization, I think what's one of the keys, you've got to read this story in line with the infrastructure spending story. So ultimately, the infrastructure has to be executed by small, mid-cap, private sector capex players. And these guys will need financing from the banking sector to execute these projects. And so what this whole thing is going to do is going to enable the PSU banks to lend adequately to the sector, because all these days the valuations were weighed down by the fact that the NPAs were hindering the ability of these banks to lend, and that's going to get taken care of. So I think this is a much longer term story, that if the infrastructure is really going to be the driver of our economy, then the corporate banks, of which PSU banks are mainly corporate banks, have to play a very important part. Most infrastructure projects have a 70-30 financing mix. 70% comes from bank loans and only 30% comes from their equity. So I think this is a longer term play, but it's not a blind buy across all the public sector banks. You've got to pick and choose the banks which can use this recapitalization to free up their resources. And which have the network, which have the balance sheet to lend to these mega projects. So I think there will be a lot of study and analysis of where this money is going to go. And bear in mind that 1/3 of the recapitalization actually has to come from the stock market, right? I think of the 2,11,000 crores, 2.11 lakh crores, I think about 70,000 crores will be coming from the market, so the stock market. So they'll pick banks which will go to the stock market to raise funds. So it's not that all of us is coming from the government to recapitalization bonds. So there'll be a dilution of equity of those banks. So this has to be, weighed and measured in the respective banks' balance sheets and see how they handle it.
That's true, but banks are valued on their book value or the adjusted book value basis. And if you look at, the way somebody put it into perspective, that the total market capitalization of all the PSU banks taken together at yesterday's close was around 4,50,000 crore. And this recapitalization is more than 40% or close to 50% of that value really, which means, if this entire sum is infused into these banks, the valuation should at least double. What do you think?
1/3 of this is going to come from dilution of their equity stakes. So to that extent, it will dampen the valuation pickup. The recapitalization bonds, which are in the nature of debt, they are the ones which will help boost the valuations. But 1/3 is going to come from equity. So I think that, from a price to book, clearly there's a long way to go. There's a lot of potential for valuations to go up and good returns to be made from PSU banks, right? So I think that's not at all in question. The question is, how much is the rise? Which banks are going to really benefit from more of the rise? So I was coming from that perspective.
Okay. And what is really happening in markets, Nifty and Bank Nifty are kind of getting stuck at higher levels because people are not only buying PSUs, they are selling private sector banks and NBFCs. So HDFC is down close to 3%. HDFC Bank is down 2.5%. Indiabulls Housing, Kotak Mahindra Bank, IndusInd Bank, Bajaj Finance, and all these are actually the index stocks. There is intense sell-off across these private sector financial players. What's your call on private sector financials, both banks and non-banks?
Ultimately, markets are a slave to quality and to earnings. Okay, so I think today's sell-off and all of that, you should not reach it. It's more of a knee-jerk reaction to the announcement. So people are reallocating their overall financial portfolio, accommodating the public sector banks because their outlook has become positive. On top of it, in the banking, in the overall financial services space, you have all these insurance listings which have come up. So naturally, people.
My question really is, the kind of loans that Bajaj Finance is giving out, do you think any of the PSU banks are really capable of? Do they really have these skills? Do they really have the systems in place where they could, cater to the same customers and take some customers away from the players like Bajaj Finance?
I don't think that's the problem for the larger banks like an SBI and a PNB. See, their network is phenomenal, and I think over the last decade, there's been a lot of improvement in their systems and processes in turnaround times. They have created separate wings for asset processing. The branch managers are left to do only marketing. So I think it's not as bad news as that they can't compete with the Bajaj Finances or the private sector. They will compete, and on the contrary, they have much more headroom in terms of a larger CASA balances, which the private sector players don't have. Especially NBFCs don't have the benefit of CASA. So when it comes to a price war on the front, I think that you will see that they will carry an edge because it was the NPA hangover which was actually freezing the decision making within the banks in terms of aggressively approaching the consumer financing business. So I don't think that it's going to be that difficult for them to catch some market share and think. Yes, speed of turnaround and all that of a private sector player is going to be much faster. But if you see SBI still has a very good share in the housing loan market, for example. So the turnaround times of these public sector banks compared to a decade ago have improved dramatically. Yes, they're still not somewhere there, but I think it's a question of people. If you're going to get a loan cheaper, would you not mind waiting for 2 more days to get a cheaper loan? So I think there will be a balancing factor in terms of the ability of these banks to gain market share in consumer financing. Also, there will be a small uptick in their market shares in this. So it's not that they cannot compete at all.
So there is a definite risk for the growth rates and the earnings growth for the private sector banks and NBFCs. Does that mean, the kind of buying that we have seen today in PSU banks could just be the beginning? Over time, fund managers like you will probably reduce some of the weightage in private sector banks and NBFCs and try to buy PSU banks on any decline, if at all you get?
See, because the Bank Nifty is concentrated on 3 or 4 stocks, right? So the place is much larger and wider. And naturally, if the overall health of the public sector banks is going to get a boost from the government, and as I mentioned, the private sector players are not really in a position to capture the corporate lending book. Okay, so there, the players that you mentioned, like a Bajaj Finance and all, they don't compete at all in the infrastructure lending space. So naturally, when infrastructure is going to pick up, the public sector banks are going to be at the forefront, and a few private sector banks too, in terms of being able to lend to infrastructure projects. So that's a place where there's limited competition because NBFCs don't have a significant play in that. So definitely over the next 12 to 18 months, you will see that as like I said, I'm again like to point out, right? Recapitalization news is a temporary news today. One is the execution. Second is it's the infrastructure, the lending. Ultimately, banks have to from net interest margins. That's got to be their core business, and it depends on the and if we are as a fund house, we are bullish on the infrastructure space over the next 3 to 4 years. So naturally, if we are bullish on infrastructure, the people who are going to finance an infrastructure also have to form part of the portfolio. So yes, you will see a reallocation within the financial services space, but it need not mean that it comes at the cost of the private sector. It could mean that the overall allocation to the banking and financial BFSI space will increase in the market. Right? It's not necessarily that it has to come at the cost of the other. Because retail consumption and all of that is still a continuing story in our country, and the private sector players will continue to benefit from that.
Okay, so private sector will also continue to benefit. This is an economic stimulus really, and not just a PSU banking stimulus. That's the way to look at it probably. But let's move on. Before that, let's have a look at what's happening to PNB. It's up 32%. That's the top. The hot favorite. Bank of Baroda follows with gains of 26. Bank of India is up 25% now, and Union Bank is up 25%. So market is kind of concentrating on these large cap PSU banks, large to mid cap PSU banks to begin with. The smaller ones like Dena Bank have not really moved up, have not really done that well. But there is another sector, Sunil, that we should be focusing on, as government announced a 5 lakh crore rupees investment in road project. Let's see what has happened to some of these stocks which are likely to benefit. Sadbhav Engineering is up 6.5%. Dilip Buildcon is up 4.5%. Ashoka Buildcon is up 4.5%. You have Gayatri Projects also moving up on this news. You have other cement stocks like Prism Cement. You have construction players like NCC and IRB Infra that figure among key gainers this morning. How do you really look at this plan? The government has been investing in a big way in infrastructure. Do you see additional allocation really, or this is just the way of restating the numbers? How do you really see it?
No, see, I don't think there's a choice. See, the infrastructure has to be the key because employment generation is the key. And I think infrastructure has the biggest potential to generate employment, especially in the very low class. The spin-off of infrastructure projects come from cement and steel demand, transportation, logistics, the whole bunch of things. So I think the impact that infrastructure can create, it's a Keynesian model of fiscal stimulus where the government steps in to pump prime the economy. So I think this is a critical thing, and the government for the next 12-15 months or in the run-up to the election is going to increasingly focus on this because job creation has to follow. So we believe this is more a sustained thing. and it is definitely a fresh allocation. Yes, some of it is repackaging and re-announcing it at this particular point in time, but it's a sustainable force, and over the next, if you have a 3 to 5 year time frame, and I'll tell you why, because infrastructure, if you take, you mentioned price to book on public sector banks, price to book is also the way infrastructure companies are valued, because, you know, they make losses in the downturn and make huge profits in the upturn. If you were to compare price to book of, let's say, the Nifty Infra Index, and compare that with the price to book of Nifty, you are trading at a 30% discount today in terms of the Nifty in NSE Infra Index vis-a-vis Nifty price to book. Whereas in the peak at 2007-8, it was at a 12% premium. So there's a huge headroom just on valuations for this to improve as the order books start flowing. So I think all of these government projects, what is important to see is how far they go through the tender to award, award to execution, financing tie-up, and then execution. So I think you need to have a clear 3 to 5 year time frame if you are investing in infrastructure. But if you stick with it, I think the profit potential is huge because of the valuation gap that's currently in existence.
Okay, let's move back to the NBFC space. Edelweiss Financials is now down by 12 to 13%. Yes Bank is down by 10%. You have Canfin Homes, which has fallen by 5%. JM Financials is also down by 5%. Bharat Financial Inclusion, Kotak Mahindra Bank ahead of numbers is down by 4%. Indiabulls Housing, HDFC Bank and HDFC, Dewan Housing Finance, all these NBFCs figure among the top losers. But Edelweiss is the worst hit so far. And among private sector banks, it's the Yes Bank, which has fallen by 7.5% to 8% so far. So there is a lot of intense pressure. Looks like people are shifting, like Sunil suggested. There is a shift from private sector to PSUs, and this re-rating or the shift could continue for a while. Sunil, thanks a lot for taking time out for us this morning. Well, that is where we are. Markets at 10,260. So Nifty and Bank Nifty have come off because they have actually, they are influenced more by private sector banks and NBFCs than PSUs because the weightage is higher on that side. So Nifty Bank is down. The right index really to watch out for is the PSU Bank Index because that is moving up 22, 23%. Well, that's huge. With that, we slip into a short break. But up next, we discuss the government's 2 lakh crore lifeline for PSU banks with former RBI Deputy Governor KC Chakrabarti. Government 7 lakh crore investment in highways with YD Murthy of NCC and the Power for All plan with PV Ramesh of REC.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people. Welcome back. You're watching Indian Open. The government has announced a close to 7 lakh crore rupee Bharatmala scheme with the aim to build or complete over 80,000 kilometers of roads across the country. The target is to finish these projects over the next 5 years. Joining us now to talk a little bit more about what some of the new initiatives within this Bharatmala scheme might be is Y.D. Murthy, Executive Vice President for Finance at NCC. It's one of the biggest road construction companies in the country. Sir, good morning to you. Thank you very much for joining us, Mr. Murthy, on Bloomberg Quint. Let me start by asking you if you could identify from within this plan of building 83,677 kilometers of roads over the next 5 years, what part of it was maybe a new announcement, an announcement towards new projects, or is this an aggregation of the ongoing works, the leftover works, and the already proposed works for the next 5 years?
Yeah, absolutely. You must be aware the earlier NHDP program was there, National Highway Development Program, started by the same BJP government way back in 1998, and of course taken forward by the next UPA government also. See, one basic factor is India is a deficit in the transportation network, and they are setting it right by starting various initiatives like NHDP 2, 3, 4 and all that. Now they call it the Bharatmala. It's fine, 80,000 kilometers in 5 years. Particularly the economic clusters are going to be connected. So that will give more mobility, and also it will help the manufacturing sector. The logistic cost of transportation should come down. And which
but
will
Mr.
help
Murthy,
us
does this amount to, for companies like yours, does this amount to the potential of substantive new orders, or is this business you had already potentially factored in?
This potential is not there. See, NHA per year about 7,000-8,000 kilometers of road network they are awarding, both on the EPC mode as well as the hybrid annuity mode. I think there will be some more improvement in that with this Bharatmala program, and more orders may be coming. That will definitely be a very positive thing for companies like us, and definitely will participate in the new road network that the government
So when you say there will be a somewhat improvement, could you quantify that for us, saying after what you heard yesterday, do you expect the potential order, the order opportunity at least, to expand by 10%, 15%, 20% over the next 5 years?
You see, current year so far, NHA has not given much of orders. Maybe it could be a variety of reasons. Last year they have given more, nearly about 5,000 kilometers. So this program, Bharatmala, will see that the order award will improve substantially, even beyond 15-20% as compared to what it was so far.
Okay,
and
so if they did 5,000, if they awarded 5,000 kilometers last year, now what do you estimate will be the awards for this year, given that you already pointed out that the first half has been quite lean, but with this Bharatmala announcement, maybe the second half will pick up. So what kind of, sort of total amount of road awards do you expect to come in from the NHAI over the course of this fiscal?
It is difficult to say at this stage, because unless they have the detailed project report available with them, and then the land is acquired in advance up to at least 80%, then only they can call for bids. So to give a number at this stage is very difficult, but definitely it is a step in the right direction. 5 years, 80,000 kilometers, approximately 10 to 12,000 kilometers per year, that is what they are planning. I think that will be a good thing for the economy as such.
So one newspaper estimated this as the doubling of the current run rate from about 20 kilometers a day to a little over 40 kilometers a day. Is that how you've assessed it as well? And do you think that's a realistic target?
Yeah, you see, as we discussed already, if 5,000 becomes 10,000 or 12,000, this doubling is there, which means per day construction activity also must go up from 20 kilometers to 40 kilometers. Definitely that is possible. And the other important point is the Indian construction industry has matured a lot. We have got the capabilities to execute projects faster and quicker, provided the right environment is available, land acquisition is taken care, payment cycle has improved.
Lovely. I'm glad you brought up payments. Let's talk a little bit about the funding of these projects. The bulk of it will come from market borrowing. I would imagine that would be on the NHAI balance sheet. Private investment, a little over 1 lakh crore rupees, and then some of it from the CRF or the Central Road Fund, and a little bit from budgetary support. Do you think the financing conditions now, especially with all the changes that the minister has made over the last few months and quarters, have made it easier for you to be able to execute projects?
Yeah, as far as cash contracts are concerned, the EPC, where NHA has to bring the money to the table and pay the construction companies like us, definitely that sector is doing very well. There is in fact aggressive bidding and very good price discovery is also happening. But the question is how NHA will be able to find that money. They have got a game plan from market borrowings and also some monetization of the existing road assets. All these things they are planning. So that part is clear, but the only thing that is a bit difficult to ascertain at this stage is the PPP mode, that is the hybrid annuity, where the developers have to also to bring in equity money and to take up the projects, and also they should be able to arrange for debt financing from the banking system. Banks are not coming very willingly for funding these projects, particularly depending on the borrower profile and things like that. So all these issues have to be carefully examined.
All right, fair enough, sir. So if I can just summarize what you've told me, because we're trying to ascertain what the impact of the government's announcements would be for companies like yours in both the near and the medium term. And effectively what you're telling me is, while it is a great articulation of the government's intent to focus on this part of infrastructure and that it might also lead to the doubling of road orders in the year, immediately you don't expect any benefit from this.
Orders will come. See, it's a 5-year plan. It immediately means next 3 months it may not come. But the direction is very clear. Road sector will have very good opportunities as we go forward, which is definitely good for the country, good for the economy, and good for us.
All right, so we'll leave it at that. Thank you very much for joining us this morning. That's NCC saying orders will come, maybe not in the next 3 months, but they'll come and the direction is great. And as one analyst I was just telling you told me, I asked him what's new about this, and he said the articulation is new and very welcome. So.
All right, that says a lot. We're getting back to the big bank recap plan. And before I go across to KC Chakravarti, former Deputy Governor of the Reserve Bank of India, I just want to point out what bank stocks are doing this morning. Long-term charts, if we pull them up, you'll see that the PSU Bank Index is perhaps up the most it has been since its inception. You've got stocks like State Bank of India up 20%. Punjab National Bank at one point was up 30%. Bank of Baroda still up 22%. The optimism around what this 2.11 lakh crore can do to turn around the fortunes of the banking sector or these banks is very high. Will it actually play out that way, or will we see a lot of money thrown at banks which haven't been performing at their best for many, many years and decades now? That's the question I'd like to put across to Dr. KC Chakravarti, who's joining us via Skype from Dubai. Dr. Chakravarti, very good morning to you, sir. Ira here from the Bombay studios. No complicated questions to you, sir. Just your view. 2.11 lakh crore is a lot of money to put in 2 years, sir.
You see, let me first come that amount of money. You see, look, Ira, I am little bit, my apprehension is that it is too small money. Let us understand. Look, the NPA of the banking system, a majority of it with the public sector bank, it is already 10 trillion rupees. Now, if you see the provisioning gap, now the provisioning coverage ratio is only 40% if you see all the banks. So already there is a gap of 6 trillion rupees. Now, over and above, there are accounts which are restructured, which are 5/25 scheme, which are strategic restructuring, and many where the accounts have still not been classified as NPA, and it has come out from the Axis Bank case that even accounts which are not under watch list, they have become NPA. So my own mind, the total provisioning gap in the system is about 8 trillion to 10 trillion rupees. Now, against that, if you see the banks, they have written off about 5 trillion rupees in about 3 trillion rupees in the last 5 years, and every year they are writing off now around 1 trillion rupees. So that much has been provided, and whatever the provision they have made in the last 5 years, out of their normal profit, out of whatever capital government has given, it is 2 to 3 trillion rupees. So if you see against a gap of 8 trillion, 2 trillion is the only coverage. I don't think it is going to make the banking system healthy. But more than that, even 2.11, when you say capitalization, there is no cash inflow. What do you mean by capitalization? Capitalization means that the company gets the capital for absorbing the loss. Here there is no cash inflow. The cash inflow component, I am not very sure, but what I have seen, it is only some 36 crores or 46 crores. I don't know exact amount, you can find out. It is insignificant. Remaining is all cash neutral. Now, cash neutral situation can improve the regulatory capital adequacy ratio of the bank, but in no way it will help the bank to absorb the loss. So banks will remain in the large, they will be the problem, and we must understand that it is the case of corporate sector. Banks are not lending to the corporate, not because of lack of capital adequacy. No, if some way by doing the accounting jugglery, you are increasing the capital adequacy ratio, but there is no cash inflow, I am afraid it is not going to help the banks.
Dr. Chakravarti, your view is diametrically opposite to what everybody has said so far, but that is the reason we wanted to speak to you, because you always have a different perspective. One point though, sir. So I know you're saying that this is not actual cash, but liquidity is not the problem with banks right now, sir. If you give them capital, do you not think that they'll be a little bit more willing, firstly, to do a little bit additional provisioning, take the write-offs that are needed, and then as and when corporate credit demand comes back, at least then they'll be in a position to lend, sir?
Ira, you have missed the point. There is a provisioning gap of 8 trillion rupees.
I know, sir, but can I... Sir, sorry, I'm going to interrupt you. I agree.
I'm again telling you,
okay.
Banks are not lending because they have to first make this provisioning.
Yes,
they
sir.
They are not lending because corporations are not coming for credit. There are other issues is the bank's problem going to be solved? Is the banks going to become financially sound because of that? No, not that. Now, whether the credit pickup will take off or not, it will depend, because there is no equity even with the corporates. You see, we are not understanding the problem. From 2004-05, banks have not gone for any equity issue, public equity issue. It is only government that's contributed in those days, some maybe 10,000, 20,000 crore every year. Look, I may be different view, but look, I can always have a contrarian view, and I am giving my analysis. I don't say you agree with my view. You are asking my view, I am presenting my view. I agree that banks are not lending, not because of the amount. So that's what I'm saying. Anyhow, you are not improving their loss absorbing capacity. Now, unless you make other structural changes, if you are making, not because of this thing, the situation going to improve. You are making reforms, restructure in other area, projects are implemented, the borrowers are getting the capital funding, I have no problem. They will be execute the project with their own money, I have no problem. That is the thing, credit may pick up thereafter.
No, sir, we completely, the reason we wanted to get your view is to not keep hearing the same view, so we appreciate your views completely. Let me take a slightly different track, sir. Yesterday, along with all this announcement about, the 2.11 lakh recap bonds, etc., the government also talked about how they want PSU banks to lend into the SME sector. They talked about bringing in sector-specific mudra schemes, etc. What the red flag that raised to me is that the government is not going to back off from this directed lending. First it was infrastructure, now it's SMEs, whatever the priority of the government of the day is. But that, sir, is dangerous, because then, like you said, this money will get used for some provisioning requirements, etc. 5-7 years, when the cycle turns bad again, we'll be back to the same point.
You see, look, all what I am saying, what is mudra scheme? Look, what you are saying, you are repackaging the sense. There is no additional flow of credit because of mudra. You see, we are all talking for agriculture, SME, we are doing only lip service. Please understand, credit is not picking up, mainly because corporate credit is not picking up. You will be, if you are doing MSME, if you are doing agriculture, I am not against directed lending. In fact, banks which have done more priority sector lending, they are more healthy. That is not the issue. But issue is that unless the economy revives, unless the big capital projects are implemented, even SME will not get the opportunity. Yes, something they will be doing in the informal sector. There are other issues. GST is there, demonetization is there, where they have suffered. But I'm not going into this problem. We are focusing on the bank-specific issue. That is it a big number? I say no, it is not a big number. Is there a cash infusion? No, this is not cash infusion. There are other problems. If you want to discuss, you have to come for a different discussion that what government is doing, it is sufficient. But Mudra is not a new scheme. In fact, the total refinance provided by the Mudra Bank is how much you can find out. Banks were, even for the last 30 years, banks were lending for the SME, for agriculture, for priority sector. If you all of a sudden say this is Mudra lending, it is not adding any, giving any new thing to the system.
Okay, let me ask you this, sir. You said it's not a lot of money, it's not cash infusion. If you had to come up with a way to sort of, strengthen, I won't say revive, I'll just say strengthen the PSU banking sector at this point, what would you have done? Would you have done larger amounts and cash infusion?
You see, look, I am very clear, government has no money. Please understand. That is why you see, I am not saying intention that the government is not bad. If they had the capacity, they would have given 6 trillion rupees. I have no problem in that. But they don't have money. So privatization of the public sector bank is the solution. We are not understanding the problem. We have to bring new cash equity in the system. If the government has no money, country has no money, then we have to bring the fresh equity from outside. There is no other way we'll be able to get out. I am again telling that, look, this time the problem is much more acute. It is much more severe, and it has accumulated over a longer period of time. And unless we take drastic measures, it is not going to help the banking system.
Absolutely, Dr. Chakravarti. Hope they're listening to you. Privatization has to come back on the agenda. At least the conversation has to come back. Thank you, Dr. Chakravarti, for joining us.
Capital. If the government is not able to give the capital, somebody else has to give the capital. Please understand, no public sector bank has gone for an equity issue from 2004-05. I remember PNB last equity issue when I was the executive director of Punjab National Bank.
Yes, small ones like Dena Bank, etc.
You see, for 10-12 years after financial crisis, you have not brought any fresh equity other than what government has contributed. And government's ability, capacity is very, very limited because of fiscal issues.
With the exception of SBI, sir, you are right, and some one-odd small issues, but very, very small amounts.
Somebody has raised. You see, look, SBI, how much they have raised and what is their requirement. You see, look into that. You see, all what I'm saying, dimensions of the problem, I have made it. You have a provisioning gap of minimum 8 trillion rupees.
That's true, sir. Those numbers are absolutely correct. Dr. Chakravarti, thank you for joining us from Dubai. Hope to see you in Bombay soon as well to discuss this further. Appreciate you taking the time.
All right, that was one skeptical voice, in the sea of...
It's good to get a...
yeah, no, and it's not. And I wouldn't even call it a counter view. I think it's a real view.
It's a real
on
view.
how we've taken maybe a step ahead, but there are so many more steps to
100%.
take in this process and this resolution. All right, we've discussed banking, IT, infrastructure. We're also going to talk about electricity today. Now, you may recall that just a few weeks ago, Prime Minister Modi launched the Saubhagya scheme, in a sense, preponing the government's target of power for all by 2019. REC will be one of the nodal agencies channelizing funds to complete these projects. This is last mile power connectivity, if I can call it that. Joining us to talk about the scheme and about the power outlook, we have with us PV Ramesh, the Chairman and Managing Director of REC. Good morning, Mr. Ramesh. Thank you very much for joining us here on Bloomberg Queen. We've been wanting to speak with you ever since the Saubhagya scheme was announced. I'm sure you now have had enough time to gauge what that scheme will mean in terms of business for your company and financials for your company. And if you can take us through some of those details, that would be great.
Thank you. Good morning for having me. REC has two principal pillars. One pillar is the commercial pillar, which is the financing. The second is where we are the nodal agency for the government programs, and that includes a range of them. The Deen Dayal Upadhyaya Gram Jyoti Yojana, the Ujjwal Discom Assurance Yojana, National Electricity Fund, and the Power for All, and now the new scheme of the government, the Saubhagya. So we essentially administer these programs of the Government of India, which are flagship programs, which are priority programs for the country, which drive the national development agenda. We coordinate, we facilitate, we support, and then we monitor and report to the government. And that's essentially our function as far as these programs are concerned. And much of the work really is done by the state governments and the state utilities, the distribution companies, which have a direct responsibility for providing power, as we talk today, to the individual households. So our responsibility is really, we have been mandated now by the Honorable Prime Minister and the government that 4.2 crore households that still remain unconnected with power be provided with electricity connectivity, and this needs to be done in the next nearly 400 odd days, so virtually amounting to 1 lakh households a day. We have taken stock of the situation. We are working closely with the state governments and the state utilities to take forward this program. There's been a round of consultations with the state governments at the Honorable Power Minister's level. We've been following it up with Secretary Power, myself, and the other colleagues with the state government. So the essentially galvanizing the machinery. In addition to that, REC will be deploying staff. We already have our presence in all the states across the country. We are fortifying those machinery at also DISCOM level and the district level in order to ensure that we accelerate this program. I mean, just it's illustrative to know that there are about 100 districts in the country of the 658 districts, which actually have about 58% of the households that are yet to be connected.
Mr. Ramesh, I'm so sorry to interrupt you, sir. Forgive me for doing that, but I was keen to try and understand, I understand the critical role that you will play in this program, but does it amount to any kind of financial benefit to your company in any fashion? Have you been able to quantify that? I think that's what we were hoping we'd get now that we've had some time between the announcement of Saubhagya and your appearance here on Bloomberg Quint, sir.
No, I mean, let me say, this is part of our national obligation. We are a public sector enterprise. We don't measure this in terms of the financial benefits. We administer the funds that the Government of India provides to us. We do get a service fee for that. We don't do it free of cost. The Government of India pays us a fee that may not be substantial in terms of, however, it gives us a huge leverage with the state utilities and the state governments. And much more importantly, the Saubhagya scheme, which really looks at connectivity to every household, would also require a substantial strengthening of the carrying capacity of the distribution network. And this requires a massive capital investment, which is being done partly under the Deen Dayal Upadhyay Gram Jyoti Yojana, which has a huge investment of 64,000 crores over a period of 5 years for strengthening the distribution network. However, the need in the distribution system in order for it to really carry the required capacity of power to every household, and also, I mean, it's not just the households that we are talking about. This would spin a whole host of micro and small enterprises in the villages, commercial activity, once the power reaches every habitation, every village. I mean, this is a transformational opportunity. So we obviously have need for investment in those areas. So that opens up a new vistas of opportunity for business for REC. So we are basically looking at both things. I mean, in a way, as catalyzing the national development, being a spearheading that process. At the same time,
you used a very evocative word when you say vistas. You used a very evocative word when you said vistas. What kind of new, let's say, orders rather on the T&D side or otherwise would you expect because of this program, and therefore what your participation would be from a loan book point of view?
No, let me be a bit more illustrative. Actually, one of the major bottlenecks, I mean, if you see our total installed generation capacity is almost 330 gigawatts, and our peak demand is about 170 gigawatts or so. However, there's a huge latent hidden demand everywhere. I mean, people keep saying, you know, we are still using gensets, we still don't have access to 24/7 power. So one of the major bottlenecks had been in the T&D segment, and that's where a big investment is being made already by the central government as well as the state governments through the public investment as well as through the public-private partnership route. In order to even out these bottlenecks. I mean, today for the first time perhaps we have a national grid which can carry power from one end of the country to another end. And now the second big threshold to be crossed is really has been the distribution systems. I mean, where you reach out to the villages, reach out to the towns in the remote areas. So those investment is being made under Deen Dayal Upadhyaya Gram Jyoti Yojana, and now with Saubhagya really reaches out to the household. So this link between the substations and the household, so which basically means upgradation of the transformation capacity, additional distribution networks, and separation of the feeders in order the domestic industry and the agriculture are separated. Smart systems in order for us to monitor these more efficiently to reduce the AT&C losses. So a whole range of investments that are required in the distribution network is where we see a big opportunity. And as we already see our loan book in the first 6 months, you could very well see that our T&D sector has grown much faster, much bigger than compared to the generation segment.
So we do want to put and
then second big area is
Mr. Ramesh, if you could just bear with me for I think a minute or so. We do want to put a couple of more questions to you, but we also have to take into account the fact that we have a big company today listing on the bourses. That is the government-owned GIC, and there, as you can see, it is the gong about to go off on the GIC listing. Let's take a look at where that number comes in.
Congratulations.
Well, that's 858 for GIC. As you can see, down about 6%. That's GIC Ray, the big government reinsurance company, the largest IPO, right, in the insurance space, Hira?
Yes, so far.
The largest IPO in the insurance space.
Didn't get great institutional demand.
Reports were that LIC stepped in, to sort of help close the issue. But nonetheless, a great company at that, and this is how it listed today. So that's something we wanted to sort of bring your attention to. Let's quickly go back to see if we could get some more detail from the REC chief who's with us. Mr. Ramesh, a quick question on the loan book growth outlook from here on, and of course the question that you get asked almost every quarter and otherwise on what asset quality looks like and how much you will be able to continue to reduce your bad loan situation.
Okay, I mean, our loan book, as you could see last year, the 16-17 finance, loan book growth had been marginal. That's because essentially on account of the Uday prepayment, almost 44,700 crores. Was prepaid. So nevertheless, we maintained a robust growth in the sense that our loan book didn't shrink because of stepped up disbursement. And that trend is continuing. I mean, that trend is continuing, and we are very optimistic. I mean, as you could see, the first quarter growth, the loan book grew around 11%, and we are expecting overall this annual more than 18 to 20%. So, I mean, that's the growth of the loan book has been quite robust, and we will ensure that that remains. The momentum does not slow down. Coming to the stressed assets, I mean, which everyone is talking about, as you know, REC has the lowest among all the financial institutions, both NBFCs and the banks. I mean, we have a net NPAs of 1.4% and gross of 2.4%. And we are working relentlessly to ensure that those are restored to standard. And even our restructured asset quality is very rapidly increasing. Half of it is in the government sector. As far as NPAs are concerned, virtually all NPAs are in the private sector. So the governments have never defaulted till now. And it's important to note that 86% of our loan book really is in the government sector. So it's about 14-15% is the private sector exposure. So our asset quality, we have taken a number of measures to ensure the asset quality improves substantially and sustains that momentum. I mean, in terms of deploying project management consultants, closely monitoring the accounting, project by project periodic reviews.
If I can squeeze in one quick final question with you, if I could squeeze in one final quick question with you. Yes. A brokerage report had suggested that the government might look to dilute equity in REC. Do you know of that? And if you can share any details with us if you are aware of this information?
That's for the government to make a judgment, because I mean obviously 58.8% of our stock is held by the government of India, and it's the government's judgment to take a call on that. We of course will continue to do our business as we've always done. That's at the forefront of the power sector development.
All right, so we'll leave it there for this morning. Thank you so much for joining us.
Financing and flagships.
Absolutely. Thank you very much, Mr. Mesh, for joining us this morning. That's the REC outlook on power across the country. And we've got to quickly hand it over now to the F&O show because we're running, about 2 minutes late. So take a quick break and the F&O show comes up next. Are we live?